Hello again. Today we're going to take a look at performance in the portfolios through the end of the fourth quarter 2014. And then we'll also take a look at some of the issues that we see facing us going forward in the new year. As you can see on the first slide, portfolio performance was quite strong on the equity side as we finished up 5.4% in the quarter, ahead of the benchmark by 2 full percentage points. And for the full year, we're up almost 12.4%, which outpaced the benchmark by roughly 3 percentage points. So we've had some very strong performance in the equity side. Much of that's attributed to our large cap growth portfolio, which had an exceptionally strong year, and our underweight to the international portfolio, which had been trailing for most of the year due to recession in the European theater. On the fixed income side, you can see that we did trail the benchmark both for the quarter and for the full year period. Much of that is attributed to the fact that we continue to remain defensively positioned in the portfolio as a means of trying to protect against what we see as an inevitable rising interest rates. Our next slide looks at the overall performance from the different asset classes. Clearly, equities were well ahead of bonds, but we also saw a move towards large cap as that outperformed against the small cap markets, as well as international turning in the only negative performance as recession and slowdown across the globe weighed on stocks overseas. Finally, on our last slide for this section, the bond market, we saw a move down in interest rates from about 7 years out, as you can see from the blue line, which represents 2013, to the orange line for the end of 2014. Long-term interest rates came down substantially. Conversely, in the short end of the yield curve, we saw rates rise, and this we think is going to continue to play out for 2015 as the Federal Reserve begins to get ready to start raising interest rates sometime in this year. Overall, our outlook for 2015 is positive. We would think that interest rates are going to remain low and inflation low, so that gives us a good backdrop to see stocks perform well. As our slide here shows, there are some issues that we do want to take a look at. The first is that on a global basis, economies are beginning to separate from one another. So we are now beginning to see the United States pull ahead of the rest of the world as our economy is probably the strongest overall. That has to do a lot with what's been going on in central banks. And so the second point there on central bank policies is beginning to show that we have some changes afoot. Japan continues with its quantitative easing programs. Europe has just embarked on one beginning this week. And now the United States is beginning to end that quantitative easing program. So we're seeing some changes in how central banks are beginning to affect the overall macro market condition. But at the ground level, payrolls continue to be strong. We continue to see about 235,000 jobs added every month, and that will continue to grow through 2015. One of the other issues is currencies. The U.S. dollar has been gaining strength since 2012, but that picked up its pace last year. One of the impacts there is that commodity prices have begun to fall, as you can note here in the blue line, which shows the price of commodities dropping with the dollars beginning to rise. We see that most apparent in oil prices, which have been falling from highs of over $100 a barrel last year to just over $50 a barrel in 2014 and continuing this slide here in 2015. That is most evident in the gasoline prices, as we've seen gas drop from $3.50 last year to about $2, depending on where you live right now. And then finally, we'll see that help retail sales. As people have more money in their pockets, they'll begin to spend more, and we think that the lower gas prices, along with low interest rates, provides a good backdrop for retail sales to continue to grow in 2015.